Hi, this is David with David's Tutorials. In today's video, I'd like to share with you the basics of investing. Now by this, I mean all of the things that you might not have ever heard about what is investing and all of the components that make it up. Let's get started. Okay, now the first thing you need to understand about investing is the concept of risk. Now risk is nothing more than the possibility of you losing your money. Now you have to understand investing is nothing more than you loaning your money to somebody and them paying you rent on it and then you being able to get it back. Risk is what are the chances that the person you loaned your money to is going to go bankrupt, is going to leave town, is going to somehow lose your money. So that's the first thing you need to understand. All investing entails risk. Now, the reason people are willing to accept risk in loaning out their money in an investment is for the returns. When people borrow your money, they pay you a rental fee on that money, which is called interest, or other kinds of returns on that money. The more risk you take, the more return you are likely to get. This is one of the basic concepts of investing, is more risk could equal more returns. Doesn't always mean that, but that's the general wisdom of investing. Risk equals reward. Not always, but most of the time. Another thing you need to decide after you decide, yes, I think I might want to get into this investing thing, is how involved do you want to be managing your investment? There are active investors and there are passive investors. A passive investor is somebody who simply sets something up, they put money into it every single month, and they don't worry about it for years, sometimes 30, 40 years. And then when they're ready to retire, they look at it and they see what they've done and they get their money out and they can smile and retire and put their feet up. Other people, they want more return, and so they want to be more involved with the investment, and so they do things like monitor the markets and see what they need to do to change their investments around and get the highest return here. This is active investing, and you need to decide how active do you want to be in managing your investment. You need to know first what investing is. You've got a good handle on that to get started. You need to decide how active you want to be in managing your investment. Let's turn our attention now to the various kinds of investments that you might be able to make. I'm going to start with the investments that are on the less risky end of the spectrum, and I'll go through several different types of investments and end up with those that are a little bit more risky, but of course will have higher rewards. The least risky investment that you can make is in a savings account in a bank. And if you don't already have a savings account in a bank, I highly encourage you to get one set up. It could be a local bank, it could be a regional bank, it could be a national bank or a federal bank. Just set up a savings account and put money into it regularly. I advise people, when I was a financial advisor for the Air Force, I advise people you need to set aside at least 10% of your income into your own investment, and 10% you need to dedicate to charity. If you're a member of a church, then give that 10% to your church. That's a totally different set of videos, but we could get into that at a later date if you wish. But you should always be building up your savings account. Now, for myself, for many years, I had two different savings accounts. I had a long-term savings account and a short-term savings account. The long-term was the money that I didn't touch other than to put it into a better investment. The short-term was for emergencies. If we had to get a new battery in the car, or if we had to hire a plumber to come to the house, that would come out of our short-term savings account. Savings accounts are among the least risky because most of them, and yours should be, are insured by the Federal Deposit Insurance Corporation, the FDIC, so that even if the bank goes belly up, if it gets robbed, if the manager of the bank absconds with all the money, you get your money back because of that insurance. That's why they are among the least risky investments. Another very secure investment are certificates of deposit. Now, banks usually issue these anywhere from a period of 1 month, 3 months, a year, 3 years or 5 years. I don't remember seeing a 10-year certificate of deposit, but there may be some, I don't know. But a certificate of deposit is a bank latching onto your money securely for that period of time. And while you can get your money back before that period of time expires, you usually pay an interest penalty. And the bank is counting on the fact that if I borrow your money in a certificate of deposit, let's say you give me $5,000 and I'm the bank, and I'm giving you a certificate of deposit for 4.5% for 5 years, then I'm counting on the fact that I'll be able to loan that money out to other people at a lot more than 4.5%, and that will be the bank's profit, the difference between what I receive in interest from the loans I make and the interest that I pay you on your CD. On the other hand, you have a very secure investment with a guaranteed return of 4.5%. And that's the bargain that some people are very happy to make. The certificates of deposit and the savings accounts generally follow the national interest rates. So they will go up and down, they will fluctuate. And the bank is counting on the fact that the interest rates are going to go up some in the future so they can loan out the money at an even higher interest rate without paying you any more than you agreed to. On the other hand, if the interest rates are really high and likely to go down in the future, the banks are less likely to loan you money at a higher interest rate for a long period of time, a certificate of deposit. Now, a savings account, the interest rate fluctuates with the federal rate, but the certificate of deposit, the interest rate is locked in. Anyway, those are two of the safer modes of investing your money, in a savings account or a certificate of deposit. Now let's get into the kinds of investments that people have heard a lot about, stocks and bonds. Let's cover stocks first. What is a stock? A stock is nothing more than you owning a piece of a company. That's all it is. You own a piece of that company. And if the company issues 100 shares of stock and you own one of them, then you own 1% of that company, and that's actually a pretty good investment. If a company has issued 5 million shares of stock and you own 50 of those, then you don't own a very big piece of that company, but still you own a piece of that company. Stocks are semi-secure, depending entirely on the health of the company and the demand for the products they make. The stock market, it pays a pretty good interest rate. There are more than 3,500 stocks in the SEC in the United States, and since 1950, they have returned an average of 7.8%. I just read that in a newsletter this morning, which is why I know that. But that's a lot better than CDs are today. You can't get a CD today for, you could probably, if you do a lot of research, find one at about 5%, but is it with somebody who is very secure? Basically, it's something you have to understand on your own. So stocks are pretty good, but the thing is, you can't depend on any particular stock to perform like the market performs. Generally, they all follow the market swings up and down, but they go their own way. There are some stocks, they just zoom through the roof, and people who invested in those get really, really rich. And there are other stocks that look good, and people invest in it, and all of a sudden something happens and the company goes bankrupt. They have to sell all their assets, and the stockholders are left with zip. You've lost everything if your company goes bankrupt. So if you're going to invest in stocks, be sure you invest in a company that's fairly secure, well-known, well-established, that is not likely to fail. And do your research on it first. One of the things I like to tell people is, I know exactly what the stock market is going to do, and you can quote me on this. It's going to go up and down and up and down and up and down and up and down, but it's going to go long-term up at about 7.8% per year as the stock market goes. Individual stocks, you cannot predict any individual stock unless you do the research and know what's going on. Now let's talk about bonds. A bond is different than a stock in that a bond is an official loan secured by the company's assets. When a company issues a bond, they are usually issued in denominations of $1,000, and they issue it for a period of time. It could be a 1-year bond, it could be a 3-year bond, it could be a 5-year bond, and the company is issuing that bond at a certain percentage rate. And if they issue this bond at an interest rate of, let's say it's 4%, and it's for a year, You give them $1,000, you get one bond, and they're promising to pay you 4% of $1,000 or $40 over the next year, and then they will give you your $1,000 back. That's what a bond is. Now, if the company goes bankrupt, you as a loan holder have a claim on their assets, and they have a responsibility to you before they have a responsibility to their shareholders. If a company goes bankrupt, the shareholders could wind up with nothing, but if the company has any assets at all, you get a portion of those assets based on how many other bonds they have issued and other debts they have. The company has to pay off their debts by selling their assets, and you might get all your money back. You might get only 50 cents on the dollar, but it's a lot better than the stockholders who will be left with nothing. Now you know the little bit of difference between stocks and bonds. One of the things that happens in bonds when people get them as an investment is sometimes a very healthy company has something happen in the near term, and their bonds are listed on the market at a discount where you can buy a $1,000 bond for $900. And if it's a 5% bond, you're getting paid interest on the $1,000, but you only invested $900, so you're getting a little better interest. And when that bond matures, they pay you back the full $1,000, so you're getting that much extra back. So there's all kinds of markets out there, and people manipulating the markets and finding ways to do things. That's something that you can study up on later if you like. Another investment area is real estate. Real estate is something that requires some active involvement. It's not really for buy and hold people unless you want to buy a piece of property that you think is going to be valuable in the future and sit on it for 30 or 40 years. Then it might turn out being very valuable. Of course, it might turn out not being valuable. Again, all risk involves investment. I have been involved in residential rental real estate for more than a dozen years now, and of all of the investments I have made, this is among the very best because it involves some involvement, which I enjoy, but not an awful lot. So if my wife and I and our family want to go on a vacation for 8 days, which we just did recently, really fun, it was not a big problem. So that may be something coming out in a future video here about my take on owning rental residential real estate. But real estate is something that needs more involvement. It needs a lot of study. It needs more of a nest egg to get involved with, whereas you can get involved with a savings account or certificate of deposit with only a few dollars or $1,000, or you can get into the stock market with only $50 a month. There's all kinds of ways to do that. Residential or any other kind of real estate investment requires more of a nest egg to get started with. And finally, the other kind of thing that is looked at as an investment, even though it's supposed to be currency, is cryptocurrencies. I'll tell you a story right here. Back in about 2008 or 2009, let's say it was 2009, I don't remember exactly, I invested $500 in something called binary trading, where in the space of a day you're getting in and out and in and out and in and out, and supposedly you can make a lot of money, and I didn't make a lot of money. And matter of fact, I just kind of abandoned it, and I still have $250 sitting in that account somewhere, so you can tell I didn't make any money. But if I had invested in Bitcoin, that same $500 in 2009, I figured out about a year and a half ago that at that point it would have been worth about $76 million. Amazing. But, coulda, shoulda, woulda. It's water under the bridge, and you can't get into something by fear of missing out. On the other hand, my son knows of somebody. He was paid, I think, 50 Bitcoins for a job he did in about 2012. And he said, 50 Bitcoins, yeah, that's worth about $200. I'm not really worried too much about that. And he lost the credentials for those 50 Bitcoins. Today, those 50 Bitcoins, well, multiply 50 times 36,000, and that's how much money he just basically lost because he lost his access keys. So if you're interested in getting into cryptocurrency, my advice to you is study it thoroughly before you get started. Know what you're doing. be sure you don't lose all of the information that pertains to your crypto investment, or it could be gone. So that is, in a nutshell, the basics of investing. Investing is risk. You need to decide whether you're willing to take that risk. You need to decide how active you want to be. You need to understand how much risk you're willing to take. Do you want to stay in savings accounts or CDs and get very little return? Do you want to get into stocks or bonds? Do you want to get into real estate? Do you want to take your wealth in your hands and invest in cryptocurrencies? You need to make these decisions, and once you start going in it, it's going to be a lot of fun to learn about managing these investments. So bottom line here, if you want to get into investing, rule number 1 is just get started. Number 2 is keep going. Rule number 3 is study. One final anecdote here. There were some researchers that did a study of people who did buy and hold. They started back in the 1950s with their job. They just allocated at first $25 every paycheck, and then they upped it to $50 a paycheck. When they got promoted, they upped it to more, maybe $100 a paycheck. And they did this for their whole career, and they allocated it into a stock portfolio or to a mutual fund, and now they have exchange traded funds. But they just kept putting it in there, and they didn't worry about it. And their wealth kept growing and growing and growing. And when they finally reached the end of their career and it was time to retire, they looked at their investment account, and they had like $1.5 million because it had built up all that time, and they had just put it aside and didn't think about it. Now, how can you invest? This is topics for many other videos, but I would say that you've got local people who will invest it for you. You have got companies. You can do your own research and go with an online company like Charles Schwab or E-Trade or one of the others. Ameritrade just merged with Schwab. And you can have others manage your money for you, but nobody is going to be more interested in your money than you are. So if you have the wherewithal, the interest, the motivation, I would suggest go ahead and learn what you can about all this stuff and manage your own money. If you thought this was a video worth sharing with other people who need to know about investing, please share the video. Just click on that share button down there below the video if you're on the YouTube platform. If you're not, then click on the YouTube logo in one of the lower corners and you will be taken to the YouTube platform and you can share it with other people. You can also leave a comment down in the comment section and tell me how you like this video and if you think it's going to make a difference in the way you manage your own money going forward. Don't forget to hit that like button so you can let me and the YouTube robots know that you thought this video was worth sharing with other people and recommending. And if you're already a subscriber, thank you so much. I appreciate every one of you. And if you're not, you know what to do right now. Go ahead, click that subscribe button and then the bell icon, and YouTube will let you know by email when I post another great video right here on David's Tutorials and Vlog channel. Meantime, everybody have a wonderful day. Take care, and I'll see you in the next video. Bye-bye.